Hey everybody, it's Brian Shannon from AlphaTrends.net. Today is Friday, the 22nd of January, 2016. 14 days into the year of 2016, this market, the S&P 500 that is down 6.5%, and that's after having been down greater than 10% intraday this week. But we did reverse on Wednesday and showed some decent gains here. Obviously, still badly damaged all over the place. Even oil, which had a strong rally this week, is down 15%. So let's take a look at the numbers. We'll start actually with oil because that's really what's kind of been the driver here. And it had just been relentless selling in oil. These last four down drives from October to November, and then these other ones in here. Sharp reversal that started yesterday and continued very strongly here today. No doubt some short squeeze going on there as well. Knee-jerk short squeeze, that is, not a structural squeeze, because looking at this monthly chart, we're still obviously in a downtrend. The thing about oil is, though, and commodities, that they can reverse quickly, more so, I think, than equities typically do. I don't really like trading commodities. In fact, I don't trade them. But anyways, it's important to note that we did undercut this low from 2009, and that's where this reversal seems to be occurring. It seems to me as though a temporary bottom at least has been found in oil, but I'm not very good at picking a bottom. In fact, I don't know anyone who is. So unless I've been sitting in my chair for too long, that's about as good at it as I get. But crass jokes aside, let's take a look at the action in the indexes. This morning I had posted for subscribers to Alpha Trends this slide that I have in one of my classes, and I point out often is that gaps against the trend, that is when we have a declining 5-day moving average, when we have a big gap higher, what we often see is we get that gap up, we have a shakeout below VWAP, it rallies, and then late day we have another shakeout, which sucks the short sellers in, and we go on to close near the high. And looking at today's action, we gapped up above that declining 5-day moving average, and then intraday we did do that. We came down, we had a little shakeout here at the end of the day, and finished close to the highs for the session. Now, looking at it, from anything on a bigger picture, I had pointed out on Thursday that this is going to be, I think, a very important level going forward here for the next couple weeks if we have just made a bottom that's going to sustain for a while, and that is the volume weighted average price from the low that we had seen on Wednesday. On Thursday, we saw several tests of that level. Today, obviously, we had gapped higher away from it, and we had closed above this prior little band of support, which had become resistance. So things are looking like they're shaping up nicely. Now, for next week, the ideal scenario, and the market doesn't care about my ideal scenarios, and I'll be on vacation anyway, so I'm not really going to care. But the ideal scenario would be for a pullback down towards that VWAP, towards the 5-day moving average, that kind of refreshes this market a little bit and gives the opportunity for a better low risk, high probability trade. We had broken this downtrend, obviously, with that gap higher. And here's what we need to be aware of as a potential level of resistance next week. Just ahead is the volume weighted average price year to date. So year to date, the average price that people have paid for the S&P 500 is about 191.5. And obviously, when we back it up to a daily time frame, we're in a horrific downtrend. We can see that on the weekly chart as well. But obviously as well, you get these spikes lower, and they are often met with fierce recovery rallies. Now, I still think that we're in a bear market. This is the only time in the last several years we've had a declining 10, 20, 30, and 40-week moving average. And to me, that means the big money's getting out of this market, and that rallies, while they can and are likely to be violent to the upside, they are meant to be traded, not to be putting money in your 401k for longer term stuff. Maybe we can bounce all the way up to 200, and I think that would get a lot of people bullish, but I don't think it would change the fact that this is a broken market. So, as usual, I'm just going to trade it the way I see it. I'm going to try to ignore news because, news often lags, and the price follows news cycles typically. But let's take a look some more here at these intraday time frames. So if we take a look, here's the most recent leg lower really began just at the end of last year, And if we take a look at it from that level and put some Fibonacci on it, we've almost come up to the 38.2% retracement. Now, if we take a look at the volume weighted average price from the year to date, you can see that ties in together, making this, in my mind, a likely area for resistance. We only know resistance after the fact, but if you look at it objectively and say the average price is there, a 38.2% retracement, it's likely, I think, to at least run up towards that level, maybe a little bit through it, and then pull back a bit and perhaps refresh. We don't know what's going to happen next. If it was to just continue to go through there, fine. But fight the trend at your own risk, but know what your time frame is. When people talk about trends, for the last 3 days, we've had this massive uptrend. And had you just woken up from a coma and started buying stocks Wednesday afternoon, you'd think we're in a massive bull market. But if you look at it from anything longer than a week, we're obviously still in a market that's hurting badly. So, further bounce from here seems quite reasonable. My hope for next week is that it does nothing because, as I said, I'll be on vacation and I'm more nervous about my kids being home alone than I am about missing out on market opportunities. Anyways, the Nasdaq, let's take a look there. The Nasdaq continues to be a broken market as well. It did undercut the low from September, so obviously a much stronger relative performance to the S&P 500 since the August lows. Now, one thing I think to point out as well is the volume weighted average price, and I should do this for the SPY, since that August low, if we were to get a bounce up to that 200 level, 199, we'd still be below that volume weighted average price from August, meaning the average participant from there is still losing money. And for the NASDAQ, that would take it up here towards the 107-ish area. But anyways, let's take a look at the 30-minute time frame. We had obviously that shakeout, and we had an inverted head and shoulders pattern here and a break of that trend line, the neckline here, but the trend line and the neckline. But it did so on a gap. I mean, it's one thing to say, hey, I called an inverted head and shoulders pattern, but what can you do with it when it gaps like that? That's the point. Is that be realistic about what the market does and what where we are and where we are in relation to, for instance, the volume weighted average price today. Once we regained that in the NASDAQ and got back above this little resistance, then the buyers regain control. So, if this head and shoulders pattern is to be met with its upside objective, we start our measurement conservatively at 102 and bring it conservatively down to 97, which would be 5 points. Add 5 points to this 102.5 area. That would give us an upside potential objective of 107.5. I think that's aggressive, but you never know what the market's going to do. You just simply have to be aware of the potential scenarios and then determine whether it makes sense from a risk reward standpoint. Where do I put my risk? Where do I put my stop? And is that enough that I see a potential? Is the potential for the upside on that trade enough relative to the amount of risk that you perceive? And again, it's always going to be determinant upon your time frame. If you think we've washed out and made a bottom, maybe you put your low down here, your stop down here for your 401k. And if you're involved, then maybe you get a nice rally up towards that 100, 105 level. But as soon as it starts backing down again, then you got to get out. That's the way trading is. I'm not talking about investing, and I think you can trade your retirement money. One of my most active accounts is my IRA, and it's why wouldn't you trade in there? Anyways, the Russell 2000 has been the worst, obviously, as it really just got smashed down through these prior lows from late 2014, and even from this level here from mid 2014, we undercut all these lows. So, I think that the Russell 2000, which had obviously been, the worst performer in the last year, has really kind of exceeded on the downside and seems most likely to have the potential for a bigger bounce. Now, when we look at this daily chart, we're getting some bounce. We're at a declining 10. We've got a declining 10, 20, 50, 100, 150, 200-day moving average, etc. So it's not realistic to look at the daily charts and say what's the upside, but instead to look at the intraday timeframes to try to manage risk. In this group, the Russell broke its downtrend first, and as I often remind people, breaking a trend line doesn't mean a reversal. It means the rate of that trend has slowed. When we have a pattern of higher highs and higher lows above a flat to rising 5-day moving average, then we consider the intermediate term trend to be higher. So the volume weighted average price for this market since the low, keep an eye on that. It comes together with a 5-day moving average. I think that basically, this is going to be the important level to hold, about 98.5. If it holds above 98.5, I would think that you're going to see sideways to sideways to higher next week. The volume weighted average price year to date for the Russell, that's good to be aware of because we have that as a potential area where sellers may decide to take some profits or reduce part of their long exposure that they've been nervous about. And you can see, of course, that this has also been this prior support which turned into resistance. So this looks like a very likely place where resistance will be found. Some people will say there is resistance at 102.5, but we don't know that. We only know that it's potential based on a couple of objective technical measurements. That's all we know. If it goes up through that level, backs off, and then continues to make higher highs and higher lows, it's foolish to try to short here. You don't short into strength, just like you don't buy into weakness. You can buy in downtrends as it begins to move higher when you feel there's a good risk reward, and you've got to be ready to cut very quickly. Semiconductors right at their volume weighted average price year to date for this group, and you've got this bigger area of consolidation just ahead here at 49.75 to 50 basically that has the potential to become resistance. So the best scenario I think for next week in the semiconductors would be for them to, maybe they gap up a little bit and then begin to pull back in here and then to stabilize. If they did something like that, then it would be more likely to be able to sustain a bigger bounce to the upside. Otherwise, the other scenario, don't forget, is that we can get smashed from here. If you look at the biotechs, for instance, and look at this pattern where we have right now, this sell-off and then this sideways action. A lot of people say, well, that's support. Well, a lot of people, don't forget, said the same thing about a company called American Express. It looks very similar here, that we saw that it was, that American Express was oversold coming into this year or down too much, people might say, and then it kind of went, found so-called support. And it looks very similar to the biotechs. Now, I'm not saying that's going to happen to the biotechs. I'm saying be aware of the possibilities. There are no blue chip stocks. That's a marketing term. We covered that in the end of year video. IBM is not a, if that's a blue chip stock, no thank you. It's a marketing term, blue chip stock. So let's go back to those biotechs. They've been beat up badly as well. The weekly time frame, we're still in a bear market. We've got a declining 10, 20, 30, 40-week moving average. That means the longest term trend players, those who look at the 200-day or 40-week moving average, are net sellers of stock. The big money is a net seller. So when we get bounces, do not expect them to just continue to reverse higher. That's completely unrealistic. We have way too much potential for resistance at the prior support at these declining moving averages. Now, it could happen. Anything can happen in the market, right? But what's most realistic, and how do I manage risk in between? Right now, when we look at these biotechs, we see that they're starting to show signs that, from the beginning of the year, the volume weighted average price right there about 296-ish, and we have right now a potential for a higher low, and if we get a higher high, the higher high would occur where? Right here. So if that higher high occurs at this point, is that something you would be comfortable buying? If you are comfortable buying based on your time frame, would your stop go maybe under the 5-day moving average, which will begin to rise underneath this level? What's your potential for upside? If you think it's likely to be halted in this area, well, maybe you take that trade, but do so with smaller share size. Don't be so greedy to make everything back or to make that big home run trade, because it might encounter resistance. Nobody knows. A lot of people will talk as if they know what is going to happen, and I would warn you to, just be aware that nobody knows. Just because somebody says it with confidence, or because they have a couple billion extra to sling around, it doesn't mean they're going to be the ones who are right. Listen to price action and follow objectively. Shares of Apple, actually very interesting here that Apple has closed above its volume weighted average price for the year. So the average long participant in Apple this year is now making money. The average price paid for the stock in 2016 is right at about $99 a share. So the average participant who might have purged their holdings for tax loss purposes and bought back, now maybe we're building a stronger base for Apple. So I've been adamant calling this a piece of garbage, but you know what? Sometimes the garbage rises to the top. 98.50-ish, I think, is where we would like to see support hold for Apple if it's going to continue. Here's the volume weighted average price since the low, but it's not all clear for Apple by any means. We've got a declining 10, 20, 50, 100, 150, and 200-day moving average. Stocks in downtrends like this are guilty till proven innocent. You can get nice bounces, and perhaps this continues. If it were to be a healthy one, and were to pull back, it would find support in this area. Then you've got to determine what's right for you personally. Is this going to be the little band of resistance that it pulls back from? If so, how do you position next week? That's up for you to decide. As I said, I'm out of here for a while, so be smart next week and be prepared for more volatility. Risk management is always job number one.